Thank you everyone for attending today's Life Hack sessions. It's the third instalment of the Life Hacks program, which is really exciting, presented by the City of Bunbury. We're lucky today to have Kevin from Sallis Financial Planning here today to run through with you finance hacks. So obviously all things finance, giving you a few tips and tricks. Kevin has a wealth of knowledge in this area, so we're very fortunate to have him. So thank you, Kevin, for being here today. Before we get too stuck into it, I would just like to do an acknowledgement to country. We acknowledge the traditional owners of this land, the Wadandi Noongar people, and pay our respects to elders past, present, and emerging. So I'm just going to give a quick introduction to Kevin. He's the owner of Sallis Financial Planning, which is based in Bunbury, not far from the Bunbury Public Library. Kevin is the owner and principal financial planner of Sallis Financial Planning, and he's passionate about helping people become financially independent in all stages of their lives. Kevin began his journey in the financial services industry in 1980, working as a bank teller, finishing his career as a bank manager. After 19 years, he decided to move into the financial planning environment, using his extensive knowledge to guide community members in Western Australia. And he's helped us out many a times with community workshops and things like that. So we're really grateful to have Kevin on board. So I'm going to go pass it over to him. I've just got to stop sharing my screen and make Kevin the host. So just bear with us for a second.
Rightio. Thanks, Danica. Thanks for the introduction. I'm just getting my own technology sorted. So here we go. Okay. So thanks very much for the introduction and welcome to everybody. Thanks for tuning in. Yes, basically I do like face-to-face so I can interact with you, in a group session. We've done this before and it's been really successful, just having a chat amongst ourselves and what's important to you and what's not. So this is new for me to present this way. So what I try to do in this program is to put together a bit of a presentation on what may be important to you as far as helping you with your finances or manage your finances more importantly. It's very hard to know exactly what age group sometimes. So my presentations includes a little bit of people that are pre-employment, for some savings, pocket money, those sort of things. And then we move into people who are working and going into adulthood and young adults. So I've tried to cover different areas. So we'll go through basically what we're talking about today. I must say that this is just a general information session. There's no particular specific advice for individuals in this presentation. So if you need, obviously, individual advice, you need to speak to someone to give you that advice because we don't know your individual circumstances. This is just an information session. So we're covering savings, pre-employment, covering your first pay packet. And I say pay packet, it's an old terminology, I'm sure, but basically you get your money and you see that people are taking money out of your pay, and what do you do with the rest of it? So we'll talk about that. We'll talk about superannuation, because that's some of the things that come out of your pay packet, and what does that mean? We'll talk about savings when you are employed. We'll talk about some of the goals you may have. We'll talk about a credit rating, why it's important to protect your credit rating and how you manage your finances and how you behave. Basically will actually help or impede you moving forward with your borrowing circumstances. A bit about budgeting, how we can help you manage that. A little bit of insurance that you'll come across as you go through your life, insurance needs. And I say roof over your head. If you're renting or buying, there's things you need to think about when you're going through those stages. So the savings pre-employment, this is obviously for someone who's a bit younger, earning a bit of pocket money, gift from friends, family, etc., grandparents, saving for a purpose, whatever that may be. It may be a bike, it may be a holiday, whatever. Save for long term, enjoy some, of course, enjoying the savings as we go. So you open a bank account. So you need to build up a good balance in your bank account and then consider investing. When you're younger, under 18, you need to have the parent help you open a banking account, and there are some tax considerations for parents to think about along those lines. So I think it's very important from a young age for a family to teach children about doing a bit of work around the home, getting a bit of pocket money, and to start teaching some good money habits. So your first job and your pay slip. So what happens, you get your information these days online, and it says you've received a certain amount of money and a certain amount's been taken out, deductions in tax, and some in super, and maybe other things like union fees or other deductions. Once those deductions have come out, you're left with what's basically your net pay. So your gross pay is your first lot, then you have the deductions come out after tax, you have your net pay. So I always have a rule, I've used this rule for many, many years. As Danica said, I've been around a bit of a while. In fact, 40 years this year. So this rule's been around a long time, and it's actually older than me. But I call it the 10% rule. So you're basically paying yourself first. So you get your money after deductions have come out, you take out 10% of your income and you put that aside. That's what I call the 10% rule. You need to have a budget. You need to list all your expenses for the whole year, and you divide by the number of pays that you receive. Most people receive their pay in a fortnightly, so it's 26 fortnights, and you place that into a bills account. So whatever your bills are for the year, whether it be your car insurance, whatever it may be, registration, etc., car services, house bills, etc., you will know after a while that those bills come in periodically, monthly, quarterly, 6 monthly, sometimes annually. And it's best to save for those over a year rather than leaving it to the end of the year and having no money. So you just divide the total amount of bills by, I say, 26 for fortnights, and place that money aside, and you'll have a stress-less life. Once you've done that, you build up a bit of a savings buffer, and just in case something happens down the road. So quite often we see people will just earn X amount of dollars and then they spend X amount of dollars, and sometimes Y, they spend more. But they don't save for the future. They don't save for things going wrong. They don't save in case of an accident. They don't save in case their car breaks down or they've got to replace something in the house, like a refrigerator or something of that nature. So you need to have a savings buffer for when things go wrong. When I say savings buffer, that can mean different things to different people. It could be $5,000, $10,000, $20,000, $30,000. Once you've got that managed, so you've managed your 10% savings, you've managed your budgeting, you've got a buffer that you've saved. Once you reach that goal, then it's a matter of saving up and considering some investments. And so obviously that's another topic altogether. And of course, it's all life's also, you know, it's not all about doom and gloom and boring savings. It's also a bit about having a purpose. Why am I saving? Am I saving for that holiday? Am I saving for a car? Am I saving for a house deposit? So we talked about deductions coming out of your pay. So just clarifying on that for you. So when we talk face to face, we have a bit of discussion about why is tax taken out? And of course, I've got to answer that question myself today, but tax is basically taken out by the government, so that goes back into the government coffers to pay for roads, infrastructure, hospitals, education, Centrelink recipients, etc., just to run the country. So we all contribute by having tax taken out of our pay. And why is superannuation taken out? Well, superannuation is obviously a form of saving for when you're much older, when you come to retirement. And the employer has to take out 9.5% of your income, your gross income, and place that into super for you. And that's a savings over, possibly 40, 45 years for your retirement. So superannuation, as I mentioned, is a savings for retirement. It's money that generally you cannot touch until you reach, at the moment 65. And at your ages, no doubt, you're saying, well, that's a long way away. I'm not really caring about super. When you get to my age, you do care a lot more about super. So it's a matter of savings coming from your wages, going into a pot, the retirement pot, for future years. So a bit more of an explanation on super. The employer will assist you when you first start work, assisting you establishing a fund, or you can do that yourself. You need to decide on what sort of investment portfolio you would like, or often as a default option. There's sometimes insurance within the superannuation, so you need to have a look at that, see whether there's any like life insurance and disability insurance. And quite often you ask the question, who is the beneficiary going to be upon my death of my super that I've saved? You know, obviously your next of kin, basically. I encourage you to check your statements when you receive them or check online. Make sure that your fund is receiving the employer contributions and any personal contributions that you choose to make as you get a bit older. Sometimes, you know, there have been cases where employers either have not made contributions to super they should have been, or they're late, etc., for various different reasons. So make sure you're checking up to make sure you are receiving what you're entitled to. So on your payslip, it will say to you, so much superannuation is going into, so much money is going into your super account. You can then, of course, check that with your online statement to make sure it is actually going through. On your statement, you also just look at fees. What sort of returns over time has that fund been returning? What sort of investment portfolio? Where's the money invested? Are you comfortable with that? Again, insurance, is it enough insurance for you? Is it too much insurance? Do you need insurance? And checking on the beneficiary. All those things should be listed on your statement. I'd encourage you, I know it's a long way away from retirement, but I'd encourage you to make some extra contributions to super, for example, $20 per week. And you just ask your employer to take that $20 out of your pay packet and put that into super. Or make that after you've got your money in saving and put that in. And if you put money into superannuation, you can put money into $1,000 into superannuation, and under a certain threshold of how much you're earning, the government can put up to $500 to match your $1,000 that you put in. They put in $500 in under certain circumstances into your super. So really, for a savings of $20 a week, that's a pretty good return that the government's also helping you save towards your retirement. That's how the rules are at the moment. They may change, of course, but that's how things are at the moment. So if you put a little bit away into your super, I think that long term, that will compound over time. And we all remember back at school when we talked about compound interest, how the interest will compound, add to the principal, and that speeds up the process of growth over a long period of time. So there's some of the things you can do for yourself in super even now. And you'll benefit from that when you get older. It's very topical at the moment. It's taking money out of super. And I've just said to you, I'm trying to encourage you to put money into super. When this whole COVID situation happened, of course, the government jumped to the front and said, well, we're going to allow people to take up to $10,000 out of their super account because of the economic circumstances. So people have been allowed to draw out 10 grand, up to 10 grand this financial year, and I believe there's another 10 grand available to people, or up to 10 grand next financial year. So a total of $20,000 that can come out of your super. There's pros and cons of making that decision, and of course each of you need to make that decision for yourself, but I'd like to think that the reason you're saving in superannuation is for your retirement, and if you can leave it in there, it's going to compound over time and benefit you down the track rather than the short-term gain now. I do understand, and the reason the government came out with it is that there are some families that are struggling. Some people lost their job. Some people are trying to keep their house by, need to make their mortgage or rent repayments, bills, etc. And some even needing it to put food on the table. So, there's legitimate reasons for it. And for those people, I fully understand. Were you taking it out and going and buying a jet ski or something? I'm not sure whether that sort of fits into the overall scheme. So good for some people, or necessary for some people. On the downside, as I've mentioned, you'll have a reduced balance in your superannuation. And it takes so long and a long time to build up your super. I went onto the Money Smart website, the government Money Smart website, and I've got a compound interest calculator there, and I worked out that if you left $10,000 in super at 5%, which is a reasonable return to expect over a period of time, and for 10 years, if you left that money in there, that money would grow to $16,500. That's how much you're sort of losing, if you like, if you take 10 grand out. Given your younger years, I suspect if you left it there for 30 years, that money would grow to $44,000. So you might think you're taking out 10 today for a short-term situation, but the long term, when you get older, you need to think about it. And if you take 20,000 out, which is on the table, in a 10-year period is 32, almost $33,000. And if you look at the figures, a 30-year period at $20,000 is a staggering $90,000. So not small change when you look at the big picture and the long term. So just need to think about the consequences, if you like, of those decisions.
Kevin, we just had a question. Someone has asked, what's a good buffer amount and how could I work out the best amount for them?
Well, I'd say off the cuff, if you've got, depends what your circumstances are, of course. If you've got a family of 4 kids and one income coming to the family, etc., the bigger the buffer, the better, of course. But if you've got $5,000 tucked away just in case the car breaks down and you need to replace some parts that might cost you $1,000 or $2,000. Refrigerator breaks down, what are they, $1,000 or $2,000? All sorts of things like that. So $5 grand, I'd say, would be nice. 10,000 probably even better. So hope that helps.
Yeah, great. Thanks, Kevin.
Okay. So we move on to savings and things you need to think about when you're employed. So we previously talked about before you start work. Now we're actually employed. We're assuming that you're opening a bank account. So obviously you're going to open a bank account if you haven't already done so. And this is as an 18-year-old or above. So you're going to the bank, obviously you need some identification. So again, things you need to consider as you're saving and as you're working. So pay yourself first, that's the golden rule. So I want you all to remember the 10% rule, if nothing else, before we finish. Leave sufficient in the bank account to cover the bills. We talked a bit about that previously, dividing your annual bills by 26 or whatever your pay period is. So leaving sufficient in the bank account to cover those. Check your bank statement, as I said, for fees and transactions, making sure you're receiving the adequate amount of your wages and direct debits coming out of your account. Compound interest, we talked a little bit about that if you start up a savings plan and you start adding to that, the interest is then added to the principal and it compounds over time. With also your financial management, you need to think about your credit rating. So how you spend your money, how you pay your bills, how you look after, if you've got a phone bill and you don't pay it, and you go onto record, that's a bad credit rating and will not help you when you go for a loan. So something as simple as missing your having an overdue telephone bill doesn't help your cause. So you really need to look after your credit rating. And scams, I put that in there because sometimes we, in the world we live in with electronic gadgetry, there are lots of scammers out there always trying to take what's not earned by them. They're trying to take our money. So just be mindful of financial scammers. So compound interest, just adding to what I was saying previously, whether we're talking about your super, whether we're talking about an investment portfolio or savings, and again, referring back to the Money Smart website, a simple savings plan, if you had $1,000 deposit and you put in $100 per month for 40 years at 5%, you're getting close to $160,000 by having that interest adding to the principal, and it generates a larger sum over a period of time. $1,000 deposit, $2,000 a month, which I know is quite a lot, but just bear with me for the example. Over 40 years at 5%, it's $3 million. And $1,000 a month, 1.5. So what I'm trying to suggest there is if you can start saving and be patient and save over a long time, you'll reap the benefits. Your goals are your personal goals, your financial goals. What do you want? What would you like to achieve? So quite often, obviously, a young person, you start off when you want to get your set of wheels, you want to get your car. You may want to travel. You may be really ambitious and want to get a house. So you save for a deposit on a house, or any goals, any financial goals that you desire. So you're going to save for these, or you're going to borrow for these. Obviously, some of them would be nice to save, especially travel. Wouldn't like to see you borrowing to travel. A house is a bit expensive, of course, to save all the money, but you need to save a deposit. And a car, of course, may be a bit of both. Get a deposit for a car and then borrow the rest. Who knows? What are your financial situation? So credit ratings and loans, again, this is what I was saying about protecting your credit rating. So you need a good credit rating with your bank. What is good credit behaviour? Like I suggested, making sure you're paying your bills. Banks these days, they can look into a lot of financial history of what you've been doing. They want statements from you to see if there's been any dishonoured checks or any dishonoured payments. Anything on your statement looks a bit strange. So you need to look after, make sure you're managing your money well, keep yourself a good credit rating, and you'll have a very enjoyable life. Obviously, if you're going for a loan, you go and apply to a local bank or what's called a finance broker, and that broker will help you with your details. They will apply to various banks for you, or at least let you know what banks are available under your certain conditions to apply for a loan. They will help you with the process. Serviceability, that simply means how much can you afford to borrow on your income and your expenditure. Like I said, good savings habit. You need to demonstrate to the bank when you go there that you've got a good savings habit. You are putting some money aside on a regular basis. That demonstrates to them that you can do that. That means that when it comes to making loan repayments, you're already doing those sort of things. You're making deposits to a savings. Therefore, you're in a habit of making, obviously, contributions to a loan. So obviously you need to decide whether, once the bank or the broker inform you with the information, can you afford a loan? And not only a loan, but are there any other associated costs to hold what it is you're buying? So obviously a car, for argument's sake, it's not just buying the car, is it? You've got insurance to think about. You've got licensing to think about. You've got registration, you've got petrol, tyres, servicing, all those things. So you've got to make sure in your budget how much you're earning, how much it costs you to live, have you got enough to pay for a loan and the associated cost of that particular item that you're purchasing. Otherwise, this is where people get themselves into financial difficulties, that they overcommit themselves. And again, it comes down to financial management. Try to make it more than a minimum repayment. The bank will tell you this is what you need to pay. Maybe demonstrate that you can pay a little bit more. That way you're paying the loan off a bit quicker. You're saving yourself a bit of interest, and you're demonstrating to the bank that you are a good credit risk for future loans. I'd encourage you to avoid credit cards, store cards, Afterpay type arrangements. I know it's becoming quite common and popular. Use debit cards instead. In other words, use your own money. Don't go using the bank's credit cards or these store cards, because they are hideously expensive interest rates, and it's just a vicious cycle that you just end up. If you can't pay it back in one fell swoop, the banks hit you with quite a large interest rate, and you can get hooked into just a whole world of pain of having this debt there and trying to pay it off each month. And a lot of people get themselves into trouble with credit cards and store cards. It's a real big issue. So if you can start off with good behaviour by not having a credit card and just using debit cards, which is your own money, you'll be doing very well. So I've talked a bit about getting your income in, what we do with it. I haven't talked much about budgeting. So why budget? And again, I use the Money Smart website, which is the government website, and I have an excellent budget planner in that site, which will help you to manage your money and where money is being spent, and it'll work it out for you, or certainly help you. So a budget makes sure that you're saving enough for your bills, as we've discussed, when they come in. So we talked about having an idea of how much it costs you a year, divide that by a number of pays. Well, of course, the budget, we need to put some money aside each pay. So if these bills are coming in, and they're coming in, various times, they could be coming in quarterly, half yearly, or annually. If you haven't been budgeting or putting that amount of money aside, that money we talked about dividing by 26 or your pay periods, then you're also going to struggle a little bit. So you haven't put anything away for 6 months. All of a sudden that 6-month bill comes in, or whatever it is, utility bill, gas, electric, or your car insurance, or whatever the main home rates notice, etc., etc. So if you haven't been putting it aside, very hard sometimes to find out of one pay, and that's where also people go a little bit wrong, have a little bit of difficulty. And yes, I put personal experience there, because when I was a young fella starting in the bank many years ago, 40 years ago, had a very similar experience to that, where I didn't put money aside. I learned. I come across some apps that may be of interest to you. It's not really my area of expertise at all. And I would encourage you to research and consider a couple that we've put up there for you to go and have a look at and see whether they help you. Pocketbook and Money Brilliant are ones that have been suggested to me by some younger people, and they will help you manage your money, where your money's been spent on an ongoing basis. So that's a little bit different to what I've taught over the years, but that's something that you can go and have a look at that yourself and see whether any of those two may be of assistance to you, and hope they help you. So we were budgeting. With our money, basically, it's obviously money in and money out. And I think we all fall into the trap of spending money on what we want and distractions. So, whether it's fast food, whether it's the latest telephone, mobile phone, whether it's, want to travel or spend money they haven't got, or cups of coffee, whatever. But the money certainly leaves your pocket, doesn't it? It comes in and it leaves pretty quick if you don't watch it. But we seem to spend more money on what we call wants and distractions. This is my wants and distractions. I'm probably haven't been as good as you guys, but I like Mustangs and motorbikes and travel also, but they're my wants. But really what we need to focus on first are the needs. So what are our needs? We need to have food, shopping. We've got a car, we need to have petrol to get to work. We obviously need clothing and heating and cooling, all those sort of things, and shelter. So they're the needs. So you've got wants and needs, and obviously we know which way around they should be. So tackle your needs first, and then your wants. And this is a bit of a story of a young guy called Tom. Tom got his first job in the bank. He was earning a lot of money. For the first time in his life, he was earning money. He was going great guns. He borrowed money for his first car, having a great time doing up his car, experiencing freedom, buying what he wanted within reason, until a year later. And this is the exact example I was saying to you before, that Tom, when he was a young banker 40 years ago, basically he didn't have the money when the bills come in. He got his car, he sorted his insurance out, had his license, all the expenses you put on a car when you first get going, and a year later, he wasn't putting money away during the year. A year later, in comes his registration and his insurance, and needing new tyres and bits and pieces, and he struggled a little bit. And then he was educated on how to divide his expenses by 26, and from then on, he never had a problem. So young Tom has had a pretty good life since he learned from that example. So the mantra I like to try and pass on to you pretty much for the rest of your life, really from a financial perspective, don't spend more than you earn. That sounds pretty simple, but you'll be surprised. Don't spend more than you earn. It's not what you earn, it's what you spend. And I can tell you my role I've been doing for a very long time, I've got clients who earn a lot of money, what I consider good money, but they still spend more than they earn. And I've got clients who don't earn very much money, a modest income, and they watch their pennies and they to spend less. And they're actually able to save more than the person that earns more. So I want you to think about that. This is the budgeting tool from the Money Smart website. As I said, you just go into the Money Smart basic website and you'll find it's basically a spreadsheet that you can push in your figures and it will help you calculate roughly what you're spending and help you set up a budget. Now, as you're getting older, obviously you'll come across insurance and whether there'll be a need for you to consider different types of insurances. And again, obviously health insurance, covering you for, your health. It could be dentist, optometrist, all those sort of things. Personal insurance, as I call it, and that's, therefore life insurance, disability insurance, income protection insurance. In case you have an accident or illness, you need to consider protecting your income. So if you had no sick leave and you basically had an accident or illness, insurance companies will help you by paying up to 75% of your income to you on a monthly basis whilst you're not well for a period of time. And trauma cover, which probably not something that you guys need to think about, but it's available, and it usually covers a lump sum for people who suffer from a major medical trauma, such as a heart attack or stroke or cancer, those sort of things. So, as I say, death and disability usually, income protection, and trauma cover. So they're personal insurances. And as you get older, and as you have a family and you have debt, etc., these are all worthy considerations of protecting your family, because if you obviously pass away, you need to make sure the debt's covered and your family's okay. Same as if you're disabled, and the same with income protection. You need to make sure money's still coming into your family to make sure that everything keeps on going. And general insurance, of course, as soon as you buy your first car, your first set of wheels, you need to think about insuring it. You need to think about all the options to insure it. And I know in the young years it's quite expensive, so that's where you need to be very, very mindful of your budgeting when you're buying a car. As I said, it's not just about buying the car, it's the other associated costs with it. So you need to talk to a firm that will help you with insurance for your car. Same as home and contents. So if you own a home, you want to make sure that if it burns down or burglary or any damage, storm damage, which we recently had, these things you've got to think about talking to an insurance company about the correct policy for you to protect your home. And of course, contents is obviously all your bits and pieces within the home, so your furniture, etc. And obviously, motorbike's the same as a car. You need to think about these insurance. Worst thing you can have is have no insurance, because that can actually really financially devastate people by not having some cover, some protection in place, any one of those three items. The roof over the head, basically, as we get older, of course, when we leave the nest, we leave our parents. Some of you might still stay there until you're 40, but back in my generation, you left when you're about 20. But anyway, wherever you are at, you're either going to be renting or you're going to be buying. So, from a financial perspective, if you're renting, you need to save, as we talked about at the very beginning. You need to be able to pay a bond, and then you need to pay the rent, don't you? So obviously you need to manage your money. So saving for a bond to make your first move, and then obviously you need to have enough cash flow, enough income coming in to pay the rent. And I put there allow for contents insurance, because you'll be renting, so you don't own the home or the house, but your contents, your belongings are within that home. So again, if there's a fire and you don't have any contents insurance, even though the home is owned by somebody else, you're going to lose whatever it is that you've accumulated in your belongings. So make sure your contents insurance. And again, hopefully for you guys, you save up a deposit to buy your own home. I think that would be absolutely awesome. So save up, get a deposit on the home. You've obviously then got to budget your mortgage repayments, other associated costs of running a house, maintenance and rates, and the Shire wants their bit to look after your street, etc., take your rubbish away. And then, of course, you've got to allow for home and contents insurance. So you own the house, so you've got to make sure that if something happens to it, insurance covers the rebuilding of it or repair of it, replacement of it, etc. So they're things you need to consider as you go through your life stage. So just sort of summarising what we spoke a bit about today, have a plan for your money and stick to it. It's all about a plan, planning. What do you want to do? Have some clearly defined and achievable goals. There's no point saying, I want $1 million. You don't do anything about it, and it's just simply unattainable in 5 years, maybe 40 years working life, quite possible. But make sure that your goals are achievable. Even the short-term goals, like I want to go on a holiday to Bali for argument's sake when you're allowed to, or whatever it is that you're trying to achieve. How much is it going to cost me? When do I want to do it? Again, to survive that period of time, so well, I need to save $100 a month, or $200 a month, or pay, or whatever it is works out to be. So it's clearly defined goals and make sure they're achievable. Otherwise, you don't achieve anything. You must write these things down. Prepare yourself a budget and keep it up to date. Sometimes we budget for something and we say this is how things are going to pan out. Sometimes they don't pan out the way we expect, so we've got to adjust the budget. Sometimes we've overspent a bit, so you need to keep it up to date and make sure you're on track. Establish a good savings habit, like I said. Try and just start putting money away, and especially I don't want you to do anything else. If nothing else you do from today's presentation is the old 10% rule. So it's a good, if you establish a good savings habit with a 10% rule, so if you remember what I said, you're taking 10% of your wages before anything else, and you're placing that into a savings type of plan. That means you're living off 90% of your income. If you can start doing that, you'll be going very, very well for your future. So put yourself in charge of your financial life, because no one else is. That you're responsible for yourself, and you can do it. Well, thank you very much for having me today. I hope that's been of some help to some people. And Danica, thank you for organising everything. I guess you take the screen back now, Danica.
We'll just leave it on that thank you screen. That's all right. Thank you so much. That was so informative. I'm sure everyone got so much out of that, and I'm sure that the people that will be listening to the recording will as well. If people do have burning questions, we might be able to direct them. Tomorrow we'll send out a thank you email and a bit of a survey to see if they've got any feedback for us, and maybe we can put your website in there so that if they've got any questions, they can contact you. Does that sound okay?
Yeah, that's perfectly fine. Thanks, Danica. Happy to answer those, at another time. People might think about them overnight or whatever, so that's fine. No problem.
Yeah. We might just need to process all that information, and they might have some burning questions. So, to everyone that's attended, thank you so much for coming along. It was great to have you here. Special thanks to Kevin again for putting on this session. It was great. And like I said, tomorrow we'll be sending out an email with the link to with the link to Kevin's website, and so that you can contact him if you've got any more questions, or if you want some more financial advice from him. I'm sure he'd be happy to help. And we'll also be sending out a link to a survey so that we can make sure that our future events are as effective as possible. So we'd love to get your feedback to make sure that all our events are as interesting and engaging as they can be. So thank you again for attending. It was great to have you here. Kevin, there's quite a few people saying thank you in the group chat, so it was obviously very well received.
Thank you very much.
We'll leave it there. Thank you so much.
Thanks, Danica. Take care.